So we're going to get started. And we're starting with Maxime or Max Shane, who is a senior VP for a variety of business sectors at Investors Bank. He's been with Investors about 10 years. Well-educated guy. He's got some degrees from Wharton, some special business program activities. And he is in charge of government, commercial real estate, small and commercial businesses in the New York and New Jersey market for Investors Bank. So he's got a wide area of responsibility, and he works closely with all the departments at the bank to deliver, what you would call best-in-class service and managing cash flow solutions. So when we spoke with him about this workshop, he said, what I'd love to do is to give people some tips about how they can best manage their cash and cut their expenses. Because, loans are a good thing, but what I'd really like to help them to do is to save money so they need less to borrow. So with that, he's got a great background, and we're really looking forward to hearing from you, Max Shane. Take it over.
Thanks, Tom. Good evening, everyone. Thanks for having me at the forum. Tom, Stefan, and all the folks who put this forum together and continue to provide financial information and resources to business owners. I want to thank you for that as well. Really helps us as bankers and financiers when we have an educated small business owner, or we have an opportunity to educate them and they already have done some research and have a background for it, because it's much easier to help them. Quick disclosure, my Wharton stuff is only certificate, it's not degrees. But I do have about close to 20 years of experience working with small business owners, middle market, commercial real estate, government, and all the mess that we have been in over the last 16 to 18 months. So I'm really happy just to share with you what my clients have been working on with respect to, especially the folks that are small to medium-sized businesses, the entrepreneurs, folks that are getting into the new businesses. What we have seen in, I guess, post-COVID type of an environment, because the cash flow options have changed for business owners. That's where we see a lot of expenses outside of the lending portion of it, where we see a lot of business owners rack up expenses and costs that now could be mitigated by the adoption of digitization and the acceleration of adopting the technology due to COVID. All of the payment solutions that we're going to talk about today have already been in place for a long time, but due to pandemic and due to the evolution of technology, we are seeing the adoption of those payments and digitization at the quickest pace ever. So I'll start by saying what a lot of my clients, we were able to help. And we look at three things. Let's look at payment options. How do you get your money in as a business owner? How do you pay your vendors? How do you get your money out? And what are you doing with access and security of your payments? So we'll start with incoming cash flow. You made a sale, you invoice someone. How do you get that cash into your bank account? Well, usually there's four ways of doing it, right? You got your simple old school way that you take a check, you get the story that the check is in the mail, then a few days later you get it, then you deposit it, then you wait for it to become available in 2 days for the funds to be available because you have this float. Okay, it's a basic thing. We still see a lot of check volume, but it's really old school. So then what's your other option? It's taking credit cards. But when you accept credit card payments, it comes at a cost. Usually it's 1 to 3% of your invoice. So you're doing $5 million in revenue, you're doing $1 million in revenue, it's going to cost you thousands of dollars to do that. What's another way of doing it? Okay, you could accept a wire, which is the most secure, not the most secure, but certainly can be mitigated to be secure. And then money hits your account, but then you got to pay $10 for wire. And if you got thousands of hundreds of invoice, it actually racks up. So let's just tackle some of this stuff. if you're accepting credit cards, especially debit cards, then your clients are comfortable with giving you their account number. If you have repetitive clients, if you're in a business that you're not selling cookies on the street, but you're actually selling consultative services, different things that are repetitive, even if you're selling plumbing services, you get an opportunity to build a rapport with your client and trust, and then you just ask them for their account number and use what we call an ACH debit, where you could go into your client's bank account and take the money out with the invoice. That doesn't cost you 1 to 3% of the invoice. It costs you 0 to 18 cents, depending on your bank. So just like that, you cut out a $300 bill. Instead of paying $6 for it, you pay 18 cents to get the money into your account. And the great thing about repetitive clients that you could work this way with is that you could create a template, and you don't have to put in all the information right away. You just have a book, a ledger that you currently run on, and you just submit payments whenever it's appropriate. And we have seen a lot of our clients, especially on the small business side and on the commercial real estate side with multifamily and tenant landlord, save a lot of money by not paying the 1 to 3% to use credit card acceptance, but not accepting wires that cost $10 for it coming in, but trying to mitigate the check volumes that are coming in because of the fraud, because of the delay in when your funds are available. So if you do those things, which are pretty basic, and you talk to your banker, you talk to your accountant, you can give me a call if you want to go into really detail. But when you got volumes of 500,000, a million, 2 million, you could squeeze 5 grand here, 3 grand there, 2 grand there, and you could get your money faster and more secure. So a lot of the incoming payments that a lot of small business owners don't really pay attention to because they have a good problem, there's a lot of growth, that's something to celebrate. And business owners are their chief executive officers, their presidents, their treasurers, they're the chief sales officer, they're the main debt collector, all at the same time. So when your business is scaling, you're in a really good shape, and you don't look a lot of the details, but you could probably save between $10,000 to $20,000 as you pick up, and as your volume becomes 5 million, 10 million, 50 million, 20 million, you could save enough where you could actually hire the controller that'll help you with your time. So that's something that I just wanted to touch on incoming cash flows. On outgoing cash flows, you have to pay your vendor, right? You have to pay your employees. You have to make payments. Now, you could do that in multiple ways. You could write a check, which again is a little bit old school, and you could hedge it by buying a product or a service from a bank that allows all your checks to be in a ledger. And if they're not in that ledger that you submit, they won't get paid. It's called positive pay. But at the same time, instead of writing the check, you could do what we call an ACH transfer. You go onto your bank's website, online banking, you set up for a particular module, and instead of sending a wire, instead of sending a check, what you do is that you initiate an ACH, which is basically a wire that's delayed by 24 business hours. And eventually we're going to go on same day ACH anyway, but right now it's still spotty. So you get that money out, then that software that uses to get the money out could actually connect with QuickBooks and update your accounts payable. So those are a lot of things that you want to think about from a time saving as well as from cost saving. Now, if your clients accept credit cards, you want to make the payment. You don't want to accept credit cards, but you want to make a payment with your credit card because you're going to get your points and you could get cash back. The only issue is that if you are putting it on your credit card and you're at 14, 15, 16, 17% rate, you got to make sure you pay it off. You don't want to get caught in that cycle for points. And the last thing you want to do is basically wire to make payments, because wires cost, from $15 to $35 domestically, from $25 to $45 internationally. Even if you do it online or you go into the branch, there's still costs associated with it. But by paying with your credit card, by paying with ACH, you will be able to save money, update your accounts receivables, and actually have some security involved there. Now, Tom mentioned earlier, hopefully somebody will speak on that on the crypto side, as what we are seeing is that more and more folks are accepting crypto. It is done instantaneously. The cost of it is a penny. And certainly what we are seeing in Europe and other parts of the world where they just don't take cash, they don't accept currency, they just take crypto. That's a little risky, but I think that opening up that component to accept payments and the ability for you to make payments in crypto maybe is a little bit not right now that everybody's going to do it, but certainly in the near future, you're going to have to adapt to it. So I tell my clients, do some research on it now, just so when you have to do it, you're ahead of the curve. The other thing I wanted to touch base on is if you are forced to take merchant services and credit cards, and you are forced to pay the 1 to 3% for accepting that, do it with a provider that would allow you to take out a seasonal line of credit. There's a lot of fintech companies out right now, and I'm not going to give them any marketing, but there's some fintech companies that allow you to accept merchant services and credit cards. The setup is fast and easy. And what they will do is that if you cannot get a loan from a bank or other sources, they will look at all of your processing and all of your swipes and use that data to determine what kind of line of credit that they're going to be able to provide you based on your seasonality. So if you're going to be forced to take credit cards and pay the 1 to 3%, do your research and make sure you go with a processor that also would be able to provide you a seasonal line of credit using the data and the processing information. That way, you don't get over your head with more money than you need, than you could pay back. And simultaneously, the data will dictate how much you could actually pay back and how fast. So if you set that up for yourself, eventually, as you become more in business, 2, 3, 4, 5 years in business, you right-size the ship, you become more profitable, you come to a bank, and then you get a very conventional loan. So there's a lot of options. And the great thing about it is that there's more options for business owners to accept payments, to make payments, to save money, to secure money than ever before. The bad news is that there's just so many of them. You have to talk to your banker, you have to talk to your accountant, you have to do your research to make sure that whatever channels you set up and whatever financial instruments you set up are going to work for you, because many of them do have a contractual obligation from 1 to 3 years. So with that said, you know, I'll be quiet and take any questions that I could answer.
Yeah, no, let's actually, let's see if that stimulated any questions in the group before I jump in with anything, because there's a lot there and there may be some questions that people have. I'll say hello to Len, who just joined us also. So I will ask a question then while people are cogitating, which is, there's a lot of very good information here, but you know, and obviously one thing is talk to your banker, but is there a good source that people can use to dig into some of the particulars, like you just talked about, this one here about the seasonal line of credit? Is there a sort of a YouTube? Can you find that information on YouTube if people want to, you know, dig that out to help them before they go see their banker? Because there's so much available, it seems to me, but I don't know. I haven't looked for this kind of stuff. I don't know if you know of any sources that are good, any websites that are good.
So I'm not a big fan as a banker promoting fintech, but at the same time, I am a big fan of helping out small businesses, because that's the backbone of our economy, right? The S&P 500 folks, they're nothing compared to the small business owners that employ like 70% of the folks in and just make the country what it is. So, like I said, I'm not a big promoter of these fintechs because they eat away at the bank's market share. But Tom, you have a good question, and I'm not going to put people through Google and YouTube. Square, Stripe, those are the type of these are the fintech companies that I was referring to.
Okay.
Eventually, as bankers, we're going to be offering that as well through a joint venture with a third party. But those are the companies. If you actually,
All right.
if you want to Google it, you're going to get probably way too many answers.
Too many answers.
I'll
Yeah,
just
you're
tell
going to
you,
get swamped.
yeah. So I'll just tell you, Square and Stripe, they do a very good job, especially with startups, because your underwriting and the risk exposure there, they set you up really quickly. They're fully digital. The interface is slick and exactly what folks would expect right now, but they're a little bit more expensive than your traditional processors. And when you do get a seasonal line of credit with them, it's easy because they already have all the data, but it's also a little bit more expensive than a traditional bank. But if you're a startup and you want to get going and you want to get going quick, there's a lot of those type of companies that will allow you to jumpstart your business fairly quickly.
All right, that's a good and honest, a square answer, if I might say.
Yeah,
All right,
and the
Therese.
other thing, Tom, I will say to it is that they're also mingling in accepting crypto. And when you will see all the merchant services providers, even the big old folks that dominate the market share right now, they are also mingling and helping business owners take crypto. So I'll give you a quick example. First Data was one of the biggest processors of credit cards. They were just bought by Fiserv, which is a fintech company. And you could expect their deliverables and their interfaces to be more aligned with the fintech model and the futuristic model moving forward.
All right, so Teresa, you had a question. Let's give you a shot.
Does every bank hi, I'm Teresa. Does every bank, any kind, on Long Island, the most banked region in America, there's so many banks here, have that HCH debit opportunity? If I go to my bank, I have a business account with a local bank and I go to them especially for our outgoing payments?
Yes. So Long Island is a fantastic banking market. And so is actually the entire New York Metro. On Long Island, there's so many banks that I would be shocked to find a bank that does not have what they call an ACH debit or ACH credit, a module. It's on your online banking. You probably have to pay $30, $50, $60 for it. But at the same time, you could offset it based on the balances in the relationship that you have, right? The only difference between, I would be shocked, Teresa, if you find a bank that doesn't offer it, maybe a credit union might not offer it. The only difference between the offerings would be how user-friendly is it, right? How does it connect with your payroll? Does it connect with your QuickBooks or your software to update the accounts receivables? All those bells and whistles, as you move up the food chain with the bigger commercial institutions, you will get a lot more options. But you could go to a savings bank and it'll be a standard, but it might force you to have another password. It might not integrate with your QuickBooks, right? So everyone will have it. It's just the evolution of it. Some banks are fast followers, some banks are slow followers, and some are cutting edge. So you're gonna find every single one offers it. It's just, what does your bank have?
Good.
All right.
All right.
Thank you.
Excellent. Thanks, Max. That's a great start. And actually, it's a perfect segue as you're talking about, how your what your relationships look like, because that's what Angie's going to talk about. She's going to talk about, how do you build a relationship with your banker, and how do you use that to build credibility, so that when you do want to go for a loan, you have you have done what you need to do. So it's not like, what am I doing? So we're turning it over now to Angie Singh Miller, who's at Bank of America. Some of you remember her predecessor, Dawn Marrero, who joined our individual workshops and talked a little bit along the same lines about relational banking. And so a little bit about Angie. She's and the best thing about Angie that we learned late in her CV is that she's a muscle car enthusiast. So she drives a Challenger and a Charger, and she likes to go fast. But she also loves small business, and for the very same reason that Max said, which is that it's the heart of the economy. It's what makes our communities work. It's what makes our communities be what they are, and that's why she likes working with small businesses. So I'm gonna just leave that as your introduction, Angie, and turn it over to you. All right. Thanks for being
Hi,
with
good
us.
evening, folks. How are you? Thanks for the introduction, Tom. Thanks for having me on this panel. It's my pleasure, and anytime I can help, I'm willing to help. Yeah, so banking, it's foundational. I'm sure most business customers, the first thing they do when they form their documents is go and open up their accounts, and that's key, because you need a foundation, you need a place to start, and you need to stay organized. When you have a bank account and you start funneling your expenses through your bank account and you start putting in your earnings that you're making through a bank account, and you start creating a system for yourself where you get to see certain patterns. You'll start noticing, hey, in the second and third quarter, I'm very successful. In the first and fourth quarter, I struggle with cash flow. So you start picking up behaviors, or you start picking up patterns from your banking. But from a foundational standpoint, banking is important, because if you're commingling, if you're putting your business banking with your personal banking, you're creating a nightmare for your CPA. And then your CPA has to decipher all that. And it's essentially you pay more for his service because you're spending more time. So banking, you start with banking, you stay organized so that you save yourself some money going into a little bit into Mac's topic. But to try not to commingle. I see a lot of clients, they open up bank accounts and then they use their personal credit cards. That's also commingling. Why bother going through a corporation or getting incorporated or becoming an LLC when you're going to start using your individual cards to fund your business, or to help with cash flow, or to purchase goods or inventory for your business. So one of the things to do once you open up a bank account is start with the basics. Open up the account, open up a small business credit card. The small business credit card will do several things for you. One, it will help you with cash flow. You can easily put your expenses on there. You can buy your inventory, your supplies on there, and it buys you about 25 to 30 days before you have to pay the bill. So think about that. Max stated, your payrolls due, your rents due, your office supplies are due. You have to pay for this vendor, you have to pay for that vendor. But if you're funneling day-to-day expenses on a credit card, you bought yourself 30 days. In addition, the business credit card will help you start building business credit. Building business credit is just as important as building personal credit. So open up the bank account. A lot of banks will start you off with a business credit card, even though you don't have business history or any time in business. A business credit card is easy to get. It's strictly based on personal credit. So one thing to keep in mind is that your personal credit will always be important, even though you have a business. So always need to maintain your personal credit. That's going to be your gateway to open up your business, because essentially the banks think the way you treat your individual credit is the way you're going to treat your business credit. And that's their gauge, or that's what they leverage to look into how you're going to treat your business credit. So start with the basics, like the checking account, maybe even a small savings where you can start putting away 8 to 10% for taxes, or 8 to 10% for sales tax, or 8 to 10% for a business, future business plans, and then a business credit card to build the credit, also to help you out with cash flow a little bit. Once you have those things set up, the bank starts to get analytics about you, about the way you're banking, about your business. And these are things that you need to always keep in the back of your mind. Certain analytics like, does this client know how to manage money? If you have, say, $100,000 funneling through the account on an annual basis, or $500,000 on an annual basis, but there has a tendency to be some overdrafts, or you write a couple of checks that maybe you might have missed some money coming in and the check had to clear sooner than the money came in, that starts to kind of tell a story. There are assumptions that start to conclude behind this activity. And we don't want certain assumptions in our business profile or in our personal profiles. And overdrafts and non-sufficient funds, they tell a story of maybe there's a cash flow problem, maybe there's a mismanagement of funds, or the business owner doesn't know how to manage their funds, or maybe the business is spending more than it's receiving. These are all assumptions, but you don't want any of those assumptions drawn when you're in the future, when you're looking for growth. Other things to keep in mind is, a lot of banks reward you for taking on additional services. For example, like what Max touched upon, merchant services. Bank of America offers merchant services, and when clients do their banking and do their merchant services, they get rewarded with like a relationship discount, or the cost effectiveness for the pricing is more cost effective for a client that has Bank of America and is doing the merchant services. And in merchant services also tells a tale. Once you have merchant services and it starts crediting into your account, then the banks can see, hey, 80% of their sales comes from merchant services and 20% comes from deposit. The other thing the banks look at is liquidity. You start conducting business, selling products, paying the expenses for, paying the cost of goods, paying for your employees, and then what you want to essentially start doing is building a profit. You want to start keeping money in your account, whether it's a savings, whether it's checking, and you want to start building, because what the bank is seeing is, hey, this client is using the accounts, they're using their credit, they're paying it on time, I don't see overdrafts, and I slowly see them building money to indicate that this business is profitable or trending along the lines where they can keep balances in their account. So all these things, they don't sound like they're relevant, but behind the scenes, the banks, when you're applying for credit, when you're applying for additional products and services, they're going to leverage this, they're going to take that into consideration. The other thing to keep in mind is I get a lot of clients that say, hey, I bank with you and I bank with somebody else. And that's great. I understand the position there. And if that's what works for you, let's not change it. But what I do tend to notice is that when clients bank at two different places, it's really not convenient. It becomes more of another job to kind of manage the banking. So that's something you want to keep in mind. Like, is this really convenient? Is this really cost effective? Why am I banking in two different institutions? What am I not getting here that I'm getting here? So you want to ask yourself questions before you decide to split up your banking in two. And the other reason why you don't want to split up your banking in two is if you have your credit cards with us, your deposit relationships, you have your merchant services with us, we get to see the business unravel. We get to see the story it tells. We see, the money coming in, the money going out. So if you turn around and say, hey, bank, I need 50,000 for equipment, or I need 50,000 for cash flow, or 100,000, or whatever the number is, the bank is going to say, you know what? I see it. I see the picture, and they may not ask for no docs because they have the picture. They may limit your documentation, may not ask you for everything because they see it. Or when you send in your documents, they say, hey, these facts match with our analytics, so therefore, let's approve the client. Those are things that are, important, and we always want to keep that in our back of our mind when we're banking. The other thing about banking that a lot of clients don't take advantage of is that many banks establish a personal relationship or a personal representation for the business client. Bank of America being one of them. That's what I do all day, is I help business clients in the field. So a lot of business clients, they open up an account and then they walk away. They don't take the time to know their banker, or to find out who their banker is in their local area. And you do yourself a disservice by not doing that, because the banker, you don't pay for the banker, but the banker's there to help you. The banker's there to make sure that you're efficient, make sure that you're minimizing fraud, make sure that you're doing things to protect your accounts, make sure that you have all the services or the products you need to help you conduct business. And, a lot of times clients don't, when I ask for a meeting, they don't want to, but after we meet, they say, you know what, I'm happy we met. There were some things I wasn't thinking, or I really need the banker's perspective or the bank's perspective in my business so that I can make these decisions when I am, conducting business. The other thing that I want to point out is I have a lot of clients that come to me and say, Angie, I need cash flow. I'm coming across a season where it becomes really tight, or at this time of the year, I don't really have much business. And it's kind of opposite, right? Because it goes back to those assumptions. When a client is doing well, that is the time to apply. That is the time to go after the credit. That is the time to show your financials and say, hey, look, this is my business. Look how well it's doing. Usually what ends up happening is clients kind of have the need and then they apply. But when we look into the financials, when we look into the accounts, the balances are low. Your interims, your profit and loss, and your balance sheets start to tell us, hey, there's a cash flow crunch here, there's a money crunch right here. And that's when the declines are higher than the approvals, because now there's a need for it. And again, it goes back to the assumptions. Is the business spending too much? Is that why they need it? Is the business highly leveraged or has a lot of debt? Is that why they need it? So you want to think about those things. You want to apply when things are good, because that's when you enhance your likelihood of approval. Those are just some of the takeaways that I've been picking up in the field with some of my clients when it comes to banking. But the key is to find your banker, communicate, whether it's annually or every 6 months, but just touching in with your banker. I even tell, I have some clients that even say, Angie, call me whenever you have an offer. I want to know if I'm ever offered anything. And I'll do that for the clients. I work with my clients the way they want to work. And a lot of bankers will do the same thing for you as a small business owner. So use that resource. And then one more thing about communication. There's a lot of disconnect sometimes with business clients and their CPAs. I have a business client that'll come to me and say, Angie, I want to buy this, I want to do this. And then when we look at their financials, it's like, your CPA didn't know you wanted to do these things because these taxes don't look like you're ready to do these things. And a lot of clients say, well, I have a successful business, but on paper it doesn't look like that because your CPA is writing everything off or not finding tax savings for you, or telling you to invest in your money in ways that will benefit you in the future. So always communicate with your CPA. Let your CPA know, hey, my 2-year plan is to move out of the space and I want to go get a double space where my rent is more, or I want to buy this piece of equipment, or I want to buy this piece of property. So always communicate with your CPA about your personal and your business plans, so that everybody's on the same page so you can help yourself. And always remember that capital is important, whether you have it or you borrow it. It's the only way to grow. And one of the things that pandemic has taught a lot of my clients is, if you have the liquidity, you don't want to use it because you don't know what's going to happen. We're in uncertain times, and you want to hold off on using your liquidity. You want to leverage capital. It's a tax deduction. It's a write-off. It'll help you grow and enhance your business. So those are just some things that I would like my business clients to know when they're just conducting their business, and they're just keeping these things in the back of their mind. Any questions?
That's great. That's great, Angie. And actually that's going to be a perfect segue into Andrea's talk. But let's take a couple of minutes to see what questions that has evoked from the group. So I'll look around and see.
This is Stefan. I have a question. And as a small business owner, do I have to personally guarantee for business credit?
Everything and anything you do today will require personal guarantee. You're not going to find somebody that's not going to personally guarantee anything for you, because from a bank standpoint, they want to make sure they get the money. So if the business can't pay, they want to go there. They want to make sure that the client's going to pay them. A lot of times the guarantee is on there as a good faith. So there is no credit indication that you're guaranteeing something. You're kind of just saying, hey, I'm going to take this credit card out. And if the business can't pay, in good faith, I'm going to pay. Or I'm going to take this loan out, and if the business can't pay, and in good faith, I will pay. I mean, of course, if there's latenesses or, it becomes derogatory, then that's when you might see a credit impact. But when you guarantee things with Bank of America, there is no credit impact.
All right, good.
Gotcha. Thank you.
All right, Teresa? Oh, you're on mute
You're
now.
on mute. Mute. Okay, there you go.
Okay, hi, Angie.
Hi, Teresa.
So tell me why I want a loan if I don't need a loan. Give me how that helps me and helps my business.
So it depends, right? It depends on your kind of business. So it's a very broad question, but let me tell you a couple of reasons why clients do go get loans. So a popular loan is a line of credit, right? A lot of businesses want a line of credit. That's like a contingency plan. So two kinds of businesses. You got a business that will borrow it as a contingency plan. I'm going to have this line. I have peace of mind that I have 50,000, 100,000 just sitting here whenever I need it, right? So you have some clients that are there, and then you have some clients that, depending on their business, there is a gap between the time money comes in and the time they have to pay their bills, right? So think about, for example, somebody that manufactures a product, or think about somebody that needs a lead time of 4 to 6 weeks before a product is designed and shipped. So if you're sending out something in 30 days, and then a client turns around and pays you another 30 days later, then you're not receiving money for that sale for 60 days. In the meantime, your rent is due. You pay your employees either weekly or biweekly. You have to cover your day-to-day expenses, your utilities. So in the meantime, those things are due in 30 days. So now we have a window here where money's coming in 60, but your bills are due in 30. So what do you do to bridge that 30-day gap? What do you do with that 30 days? How do you buy yourself that time? And that's where a line of credit comes in. You borrow on your 30 days when it's time to pay. And then when your receivables comes in 60 days, then you satisfy your line. And it's just a repetitive cycle that business clients use. So that's a common business product that my business clients leverage for that timing.
So I think that's a great question. I want to also put to Andrea, when we'll give him a chance to talk a little bit about things first. And I myself have an answer for that, but I'm not the expert. So I'm gonna save my answer until the end, when we're just kind of sharing opinions about it, because I think there is a reason, even if you don't need a loan, because I think there's a difference between want and need, because there's the need, that is, I need this for my cash flow or whatever, versus I want this for growth.
Yeah.
That is, I see an opportunity.
Yeah.
As a banker, I'll
jump in,
piggyback on what Angie said. She's right. The reason why a line of credit is the most popular is because in most banks, you only pay for what you use for how long you use it. So when your financials are good and you're having a good year, that tells a story. You want to establish your bridge just in case you need it when times are good. Because again, you only pay for what you use for how long you use it, plus or minus an annual fee here and there based on your relationship with your bank. If you have everything with your bank, I'm sure they could work with you. If you got a split relationship between 3 different banks, well, you might have to pay the line of credit, give or take. But the great thing about it is, not only is it a lifeline, right? But it also allows you to take advantage of certain situations. When we go into a recession, when we go into a pandemic, when we go into something, you'll be able to tell your vendors, hey, I need a 2% discount if I pay you in 10 days, or I pay you in 30 days. If your accounts receivables are industry standard in your industry 60, 90 days, you could probably squeeze 2% because you have this line of credit. You already have a buyer for that product or service.
Yeah.
So you'll pay the bank just for 5 days, 10 days, whatever it is, but you'll save 2% on the entire freight or whatever whatever inventory you're buying, whatever consulting that you're getting. So I think it's important to have that, to Angie's point, because when you really need it, your financials are going to reflect that, and you're going to scare us as bankers.
Good, that's great. All right, so we're to keep things moving along, I'm gonna turn now to the
Hey,
guy
sorry,
who is
Could I pop
the,
in one
Yeah.
quick question?
oh, yeah. Yeah, Mark, sure.
Thank you. Hey, Angie and Max. I'm in the startup phase, and I've drawn on my line of credit to develop product, which I'm trying to bring to market and pay inventory. And unfortunately, I don't have revenue coming in yet. So I'm just making, staying afloat on the line of credit. Are there any tips you could give me for trying to pay down that balance while I'm still waiting to, really go big and bring in solid income?
Yes, hi, I'm sorry, Mohawk, is it?
It's Mark. I'm sorry.
Mark,
Mark,
sorry.
yeah, Mark.
All right. Mark, hi, how are you doing this evening?
Good, thank you.
Good. So being that it's on a line of credit, I think that was the wiser thing to do than to put your debt on credit cards. So am I correct when I say that it's on a line of credit versus a credit card?
Exactly. Yes.
Yeah. So kudos to that, because I mean, you're talking double digits on a credit card. National average is 15% versus your line. Where's that? Maybe prime 3.25, maybe 3.75, 4.
It's
Maybe
a
even-
little higher, but much less than the credit card. You're right.
Yes. So I mean, so one of the things that you wanna think about is, well, so if let's just say your line is about 5. If you have obligations that your interest rate is higher than that, then that should be where you should start paying down debt. That's where you want to be aggressive and start paying down the high interest first. But if your debt is strictly concentrated on the line of credit, I would probably put together something maybe on a weekly basis as money's coming in, maybe funneling as little as 5, whatever you can, 5%, 10%, and just trying to satisfy the line of credit maybe on a weekly basis versus over a monthly basis. The little amounts might make a better difference than to try to find it over the month, over making the payment over the month. But like I said, kudos to the fact that payment, you're leveraging a line instead of a credit card. It's good you have that product.
Okay.
Mark, and I'll just add to that. The thing about it is that in banking and in lending, you have these things called sources and uses of funds. If you are currently using short-term lending to finance a long-term project, eventually the market will get you. And you might be holding afloat right now because the Fed funds rates are really low and you're tied to prime. But as Fed start raising the prime, which they already forecasted to 2 next year, give or take, right? So you're going to get, I don't want to say wiped out, but you're going to be in an upside down situation. So if you're going to start generating revenue in short term, then okay, float that line of credit, and then to Angie's point, start paying it down aggressively. Because on the banking side, on the lending side, you have to demonstrate that the product that you're in, which is a short-term lending product, which is designed to be the bridge between accounts payable and accounts receivable, 30, 60, 90 days, or some kind of seasonality. If you're using that product, a short-term lending product, to finance a long-term project, you will be upside down. And what's going to happen when Fed funds start raising rates, you might not have enough cash flow because the cost of that debt to service will be much higher. Any lender already has analytics in place to identify folks that are misusing capital. And if you don't start paying down that line of credit the way it's supposed to be used as a yo-yo, it will be termed out eventually. And then you're not just paying the interest only plus, 60th of the principal. You're going to be put on a 5-year repayment plan. And that could jeopardize some of your plans and your cash flow moving forward. because your payments are going to be higher than what they are right now. So again, a conversation with your accountant, a conversation with your banker, an honest conversation to make sure that the capital that you're using is fundamentally in line with when your revenue is coming in. Because you don't want to get a letter, you're paying $1,000 a month on that line of credit, give or take. You don't want to get a letter like 12 months from now that not only that 1,000 now because of the Fed funds rates is now 1,250, 1,300, but actually it's 2,000 because now the bank termed you out because they identified that you used short-term capital for long-term financing, and they identified it fairly easily because you're not paying down the line of credit the way it's supposed to be used like a yo-yo. And when you got to pay that 2,000, it might hamper your business's cash flow. And it might be, you know, a fundamental brick that now you can't use and jeopardize anything else you have planned. So just plan
Thank you.
accordingly.
Thank
Okay.
you.
All right. Well, Max is speaking some tough truth there. All right. So let us get back on and welcome Dave Colon. Thanks for joining us, Dave. And I see Ed has joined us as well. But let me introduce Andrea Irachi, and also who's the VP of Lending for Ascendus, and see what his take on this question and the way it's been raised by a couple of people. But he'll also talk a little bit about what Ascendus does and how it works with regular banks. Andrea, as his name looks, is Italian, and he grew up in Italy, grew up in Venice, and spent his university days at Padova and Siena, and then he came to Boston, and he took a master's degree at Northeastern and decided to stay, and he remains in Boston, where he operates with what used to be called Acción East. That's how I first knew it, and it's now been grown larger. It's Ascendus, and now is making small business loans all over the eastern seaboard, from Boston down to Florida, including quite a lot in New York City, where its headquarters are. So Andrea has been with them for, well, I missed exactly the number of years, but quite some years. And we welcome him to talk a little bit about how Ascendus and the other so-called community development financial institutions, which are nonprofit banks, work together with the regular lending institutions, and also a little bit about, you know, what literally are the kinds of loans that are available right now that Ascendus is working with. Andrea, it's great to have you with us. Please take it over.
Thank you so much. Appreciate your welcome, your nice words. I would like to share my screen actually, so maybe we can share some color. Really, give me 1 second. Let me just try my best to do that. I just tested before, so it should work. Okay, yeah, it is. So yeah, as Tom just mentioned, we are, can you guys see the presentation?
Yes.
Yep.
Wonderful. So as Tom just mentioned, we are a community development finance. We've been actually around for quite some time. We've been around since 1991. So I would say over 30 years. And our mission has been really helping businesses that have not been able to get a loan from bank. So I know we have many lending partners tonight, like Investors Banks, Bank of America. And just to be clear, I'm not a banker, but I actually partner with all banks. And actually, these banks actually are kind enough to supporting us in our mission. So we really work in conjunction with them. And the reason is that, as you can see here in this next slide, microfinance and ultimately Ascendus, we are a micro lender. We are really in the middle of the, I would call it, financial landscape. As you can see, I'm sure as you all know, as startups and businesses that have been started recently or less recently, there are many ways to start your business. Of course, there are like the more traditional ones that to have a rich family or rich friends, but not everyone has rich friends or rich family. So most of the times our clients come to us, as Angie mentioned before, actually, maxing up their credit cards and overusing their credit cards, or sometimes misusing their credit cards. So using like personal credit cards for personal and business expenses altogether. And most of the times paying like a very high interest. Like nationally right now, the interest rate of credit cards is like 3% interest. And I know many of you are thinking, well, but is advertised 1% or 0%? Yes, but most of the clients that we're dealing with, they actually ended up to have like a kind of like a default interest rate, and that actually can skyrocket and get like interest rate up to like 30%. So again, credit cards can be quite high interest financing. So we are kind of like in the middle between like a bank loan and again credit cards in terms of like pricing. We're definitely cheaper than a credit card. We're not that good like a bank. So my big recommendation is always like go ahead, approach your local bank, approach your community banker, speak to them, try to understand from them which are the the products that are available for you and really how you can get those loans. Especially banks can provide a lot of SBA lending, which by the way we are an SBA lender as well. We have special programs like Community Advantage Program. There's a loan up to $250,000 loan for startups as well. But again, banks also do these loans. And so I strongly recommend you, if you're a business owner in the space and looking for financing, to ask what are your SBA programs, your SBA loans that you can provide me. Typically, the SBA provide a guarantee to these loans. So banks tend to help, with the help of the SBA, tend to help businesses that again, they are in more complicated situations. Again, can be maybe a startup situation or maybe again, a cash flow situation, etc. And then I know later tonight, and this could be actually a good follow-up, we're going to have equity and investment actors in the space that can also help you. I always like to say in a different way, with us as a lender, you need to pay some interest. With them, sometimes you need to give up some shares of your company, or maybe some future sales, depending how you structure the deal. I know we're going to have an expert speaking later about that, so I'm not going to speak more about equity and investments tonight. I also want to speak again about the financial landscape where we are right now. So as I mentioned, we are really, if you look at this graph, we're really like a good option for people with bad credit or no credit. So when I put there no credit, you can see on the extreme right of the screen, no credit really, I'm speaking about clients sometimes with like 0 credit score or 575 credit score. These kinds of credit score sometimes is too low for a bank. Most of the times, and again, maybe Angie and Mark can correct me, but they're looking for something like in the high 600s. Again, we try to be more flexible on that aspect. However, as you can notice there, the community banks are definitely more affordable. So if you look at the top of the screen, you can see the banks actually are cheaper than Ascendos and other CDFIs. So again, the idea is, and it really at the end of the day, the bottom line of this graph is if you have stronger credit, and my speaking also, as Angie said before, strong personal credit, you're going to have better opportunity to get affordable loans, affordable lending. So it's really important that you understand that your personal credit is strictly linked to the pricing of the financing you're going to get. If your credit is better, you might going to get cheaper financing. Again, as you can see on the bottom of the screen, we actually have a different situation. We have lenders that are more expensive, not lending solutions that are more expensive. And again, most of the time, unfortunately, for people with bad history or not great history, that they ended up online, they ended up to deal with like predatory lenders, like payday lenders, people that can charge them up to 300% APR. And the reason why they can actually legally do that is that we are regulated by the Federal Reserve. As again, I know the banks in this panel are as well. The problem is that most of these lenders, predatory lenders, they're not, because online lending is regulated by state. So most of these lenders actually are located, or at least the headquarters, or they're registered in states where they don't have the same regulations and the same, I would say, same way to do things as we do. So that's something to keep in mind, and we can speak more about predatory lender if you like later. So what we're doing. So CDFIs ultimately are community development financial institutions, as Tom said just a few minutes ago. And we're really trying to cover that gap of clients that are trying to apply for financing every year. As you can see from the screen, this actually is kind of updated like 2 years back. And again, 2.2 million people, business owners, apply every year for capital. And over 8,000 people, 8,000 small business owners, so entrepreneurs like you, get rejected every day. So we are here for this. So if your bank, they have their good reasons. Again, I'm not saying they're arbitrarily they're going to decline you. Absolutely not. They have their good reasons, but they're declining you. There are other lenders, trusted lenders in your community, and there are many. It's not just us. Speaking about New York City, there is Buck, there is True Fund, there is Pursuit, there is NCDC. There are many others. I'm happy to facilitate the contact information if you like. They can really help you again to achieve your financial goals. So again, that's something I think very important to show you these literally 3 slides and kind of give you a understanding of what is out there, the potential solutions for you. As I mentioned, again, banks typically tend to be a little bit more conservative in certain things. Like an example, like typically, if you got a bankruptcy, a bank can consider you only after 10 years. Again, we can consider them after 12 months. Why? We can take more risk. And we can take more risk, again, as a nonprofit. We can basically try to look things differently. But again, this comes with, I would say, with a cost, with a price. Again, if you have better credit, you want to go to your bank because it's going to end up to be cheaper for you. Besides that, though, as Tom said, there are some solutions, some opportunities. They actually are about to expire, so they're literally expiring really, really, really soon. And one of those opportunities actually is with New York Forward program. You can actually Google it right now. New York Forward program, New York Forward Loan Fund. We are stopping taking these applications actually at the beginning of next month.
I'll put it
Sorry?
in so everybody can see it. New York
Yes, please.
Yeah.
And this is the state, actually, is New York State, and they're providing loans with a flat interest rate of 3%, and they're fully guaranteed by the state. And these are great loan opportunities. Not only Ascendus that's providing this, but it's also, again, NDC, True Fund, Pursuit, and other CDFIs. And that could be a great opportunity. It's slightly for a little bit more mature businesses. Why? Because they want to see that you have a decrease of 25% pre-pandemic to after pandemic. So you need to be already in operation. That's kind of, say, the only minus if you're kind of in a startup situation right now. However, this is not the only program out there. I know are coming up more programs, especially with the city, New York City. And we do have also ourselves some other programs. Thanks to CDFI funding, we received a 4% flat for other businesses, including startups. Even though they're not that high, we focus on the micro lending thing. So up to 10,000 maybe, or up to 250,000 with the SBA funding. Again, I don't want to take all the time, but again, there are many opportunities out there with CDFIs. Again, we work very closely with banks, so we recommend you instead than just Google online like a random lender, speak to your banker, make sure that again you get directed and you get guided, because most of the times the client that deal with has been referred from their bankers because they know, listen, we're not the right option for you now. Maybe in 6 months from now or in a year, you can come back with a better credit score and we're going to be able to help you. I think I can stop here, but then if you have more questions, I'm here open to answer.
I'll just piggyback what Andrea said. It's very important. There is a lot of capital out there, especially with fintech providers. Be careful. Do not get caught in a cycle with a predatory lender. Talk to your banker. Talk to Andrea. Talk to New York Forward Loan Fund that Stefan just sent over. There's more capital now than ever before. But be careful, do not get caught up with a predatory lender.
All right, so are there any questions? I have one myself, but I'm gonna wait and see what I see, if I see any hands going up or in there. All right, so I'll ask a question, Andrea. So this New York Forward program, I'm going to say a couple of things that I understand, and maybe you could just correct me if I'm wrong. As I understand, it's a 5-year loan that has a 3% rate, and that a business can borrow up to 25% of their annual revenue, up to a total of 150,000. Is that basically correct? Yeah.
That is correct. Absolutely.
Yeah. So, and this is a program that's sunsetting, I would say, on December 15th. So you'd have to get something into works pretty soon, which is one of the reasons why we put this program together quickly, because, we thought, well, if we were going to encourage people to consider this, we better do it, get the news out there. And if people want to try to do something, now is the time to do it. And then the question comes up, is it a good time? Do you go for a loan if you don't think you need a loan? Or maybe if you do need a loan, this might be a good loan to go for because the rate is pretty damn low. You don't have to pay principal on it for the first year. So, it's pretty hard to beat. Now, here's the question I have, which is that in this particular loan, Ascendus plays a role. It's not actually lending the money. It is playing a kind of a qualifying role in it, and that other banks are making the loan. How does it work exactly?
Yeah, so well, there is a pool. So once you visit the website, actually, we're a pool of CDFIs, and we are kind of like the intermediary. But
Yeah.
the state is the one that actually guaranteed the funding, and there is a pool of investors that have been putting together this capital again through the state. And what we do basically through this platform that's called Connect to Capital, and is linked to the link that Stefan just shared. Basically, we can get your application, but I'm not going to be necessarily the one processing it, because we're like 5 different lenders. So it can be us or can be another partner. And this is going to be based on mostly on your credit score, mainly on, your basic qualifiers. For instance, like every different lender have a different appetite. Again, in terms of credit, for instance, we're like the most flexible. I know some other lenders want like 650, 620, depending. But then there are maybe some lenders that maybe prefer to do bigger deals than we do, or so they are more like inclined to offer like a larger deal. So it really depending, I would say, on how your business looks like and the number you input in the platform on the state, on the Connect to Capital, and then you're going to be matched with one of these lenders that are an intermediary.
Yeah. Okay, so it's a matching process. I get it. So anyway, so that is an opportunity, and that is, as I said, is one of the reasons why we wanted to pull this program together now, because this is a somewhat larger loan opportunity, whereas the other micro loans are available on a more continuing basis, where you can borrow a smaller amount for, again, for a smaller business need. So there are at least these couple of things that are out there that I think are worth thinking about. It's obviously up to you, and it's a question you've got to answer as to whether you think your business could use a loan, and whether you want to take on whatever risk is entailed in it. But we wanted to at least create an opportunity for you to learn about it, and then and part of the workshop next week is to help you think about what you would have to do to pull it together. Any other questions for Andrea? All right. Well, great. Thanks very much, Andrea. Terrific. So let me see. Do we still have Dave with us? I don't see Dave now.
He's there.
Oh, there he is. Okay. It was the more darker room. Okay. So our next speaker is kind of part of the founder of the feast of this whole pandemic shift workshop, and what was called Suffolk Forward, which is a set of programs that were put together starting last March, when David Colon got together with Garrett Wolf, the professor at Stony Brook, and put together a task force, which met together for well over a year to talk about what Stony Brook University and the business community in Suffolk County could do to help businesses. Dave himself is a lawyer and spent some time in the legal processing business, but decided he could be an investor as well, and probably would make more money doing that, and make a bigger contribution, and he's done both. So he's very much involved in the Long Island business community. He's a member of the board of Accelerate Long Island, very much connected. His own business is Joe Ventures, so he's very much involved personally in equity investments. But he's also very much tuned into the Long Island community. And I've asked Dave to talk today, since he's got his finger on the pulse, a little bit about, where the business community is in Long Island. Where were we a year and a half ago? How does it look now? And how does it look into the future? So a little bit of a projection into 2022. Is it the time to be optimistic? What do you think, Dave? Good to see you, by the way.
Good to see you too, and good to see you, Stefan and Dan Lang. We also want to give a shout out to Manny London. I think he was on before. I'm not sure if he still is.
Yeah, Manny was here, and he would say hello to you as well if he were. Yeah,
sure. So we started the Suffolk Forward program. Actually, County Executive Steve Blown and myself had a conversation right the first literally week that the pandemic was happening. as things were starting to shut down, we talked about not only the health aspect, of course, but what this was going to mean for our businesses in Suffolk County and Long Island. And in conjunction with the county executive, I reached out to Dean London from the College of Business to see about what we could do as a community with the county government in conjunction with the business community to support our small businesses that were going through really difficult time. And we had people join that effort early on. Garrett Wolf, who was mentioned, Professor Garrett Wolf, and I kind of co-chaired that task force. We had, of course, Stefan, Tom, Dan Ling, Professor Dan Ling Jiang, who's here. We, kind of worked with others to put together a handful of programs, and one was the Virtual Expert Network, which was basically making it available to Suffolk businesses, Long Island businesses. We had virtual office hours with professors of business and students to help them identify, basically help advise small businesses in particularly those first couple of months, how they could survive. And we also put together the Tech Enhancement Program, which helped businesses, particularly restaurants, as they were needing to move quickly into they didn't already have, the delivery services, moving into those delivery services, online ordering, all that. We had a team of students with the SBDC at Stony Brook helped lead that effort. And we had, dozens of businesses help advance their technology needs so they can quickly pivot. And then we had a gift card program to help sell gift cards online. And then the pandemic shift business workshops, which is probably one of the most important programs that we put together, led by Tom and Stefan and the shift group. Almost 200 business owners have gone through the various programs put on, and you are among them. And so, I think what you guys learned through these workshops were how do you kind of survive and how do you pivot when you need to, and how do you take this as an opportunity? Obviously, a tremendous business challenge, but also an opportunity. We've seen businesses across Long Island, thrive. As we don't know, some have struggled as well, particularly those that are retail oriented and downtown oriented. And I think it's pretty clear that there's definitely sort of that shift that's continuing to happen with regard to businesses that are thriving and surviving. But it takes talented entrepreneurs like all of you to kind of see through, the hazards that have been placed in your way. I do think that those businesses that have survived, as most of them have, some luckier than others, I do think that, we're seeing the economy certainly boom. I think, many of you are seeing that. One of the bad thing about inflation is the cost of, the eating into prices. It's driven, of course, by demand. And so it means that there is a lot of demand out there for the various products and services that many of the businesses here on Long Island are providing. And we obviously have supply chain issues and other things and hiring issues that are really challenging us from a cost input perspective. And that is obviously, driving some of the inflation we see. But I do believe we think that, the inflation will play itself out over the next 6 months, probably by spring. I don't think we're going to go back to the 1 or 2% inflation that we saw, but I think more like a 3% or so kind of inflation is probably likely. I think we're likely to see the Fed, move on rates, in the spring/summer, and that will also, put sort of, a little bit of a damper on inflation and keep our economy from getting too overheated. But I think you're seeing a huge, huge demand increase, and I know we're seeing it across the businesses that I'm involved with, and I think that's an opportunity for all of our businesses here on Long Island. Workforce has got to be a critical piece. Sort of, that's something that business can't always solve itself, right? I mean, the county really and the state really have roles to play in terms of training and helping to match employees with employers. And I think that's going to be increasingly important. I was driving in Smithtown today, and just the number of signs that were out saying help wanted is just tremendous. And there was this theory that maybe that was driven by, there were, more generous than usual sort of unemployment benefits that existed for the first half of this year, actually through, into September. The fact that we haven't seen that kind of uptick in hiring, or people applying for jobs, is kind of interesting and indicates that obviously there's a whole rearrangement of sort of people's work priorities. I think the more we can kind of, we as employers kind of can cater to the employees as best we can. Obviously, not all businesses can do that in terms of location, flexible timing, and those kinds of things. I think there's much more of an emphasis, I think all of us have had, on quality of life. We've seen our whole lives kind of turned upside down in the last 2 years. In many ways, it can be our families, schools, employment, business, obviously. And I think a lot of folks are sort of saying, hey, maybe reorienting their own lives about what their priority is in life. And so, certainly a challenge. I don't think there's any silver bullet other than trying to create means for connection between businesses and employers, employees or potential employees. And obviously some of that's going to be wage driven as well. At a certain price, obviously people are going to be willing to come back. May not be the wages that we were used to paying. So that's something that's going to be a challenge for all of us going forward. But I am optimistic about the economy. I think we're going to come out of this pretty strong, and I think this is sort of the opportunity now. If financing is available and it is still relatively cheap, I don't think it's going to continue to be cheap going, once we get into next year sometime. And so I think if you have an opportunity, I think now's the time to try to get that financing. I come from the equity world, and we tend to invest in really either very high growth tech startups or larger companies. And sort of the sweet spot for equity is there because we want to see massive growth, 1,000% growth, or we want to be in companies that we can exit out of or acquisition targets in a relatively short period of time. A lot of small businesses come to me and say, hey, how do I get venture capital? And the answer is usually you shouldn't. For most businesses, venture capital and equity investing is really kind of a solution for probably 5 to 10% of the businesses out there. The vast majority of businesses, should look at bank loans, other kinds of lending, some of the things we've heard here today with the CDFIs. Those are much better tailored, more flexible, and allow you to kind of, quite frankly, retain ownership of your company. Which is the biggest advantage, I think, in many ways, is when we take a stake in the company, we help run that company, and we have a lot of involvement. For certain kinds of businesses, that makes sense. Again, if you're growing 1,000%, you're willing to give a piece of the company to an investor, like an equity investor like myself, because we help you grow that 1,000%, or we help you kind of take it to the next level. For the vast majority of businesses, having more flexible funding arrangements like bank loans and even credit cards probably makes the most sense. But always remember, the best source of capital, number one, beats anything. It's non-dilutive, raises the value of your business, is your customers' money. So, the number one thing has got to be trying to make sure, particularly those early stage companies, make sure that you're generating revenue. That's the best way to prove to yourself and potential lenders that you have a business that's viable. So obviously, goes without saying, but revenue is obviously the best way and the least dilutive way, to bring in capital to your business. So this is obviously, particularly people who are just starting out, they say, oh, how do I get lending? How do I get an equity investor? Make sure you have a business first. Make sure someone's willing to pay for your services. Make sure someone's willing to pay for your product. Then when we move beyond that, it's more the middle-aged businesses. It's getting that bank loan and getting that CDFI funding, getting the different kinds of things you heard today to try to take your business to the next level. And equity financing, again, very, very kind of specific kinds of businesses that really is applicable to. But anyway, bottom line is, Tom had asked me sort of what my thoughts on the Long Island economy. I'm bullish on the Long Island economy. I think things are going well. Obviously, there's a lot of money that's going to be put to play. I think this infrastructure bill that just got passed, I know there's a lot of politics in Washington, but I think this is a very good thing for Long Island. We have real infrastructure problems. Our roads, we all drive on them, right? Our bridges, there's an opportunity to really invest in clean energy, which is going to be a driver of jobs in the future here in Long Island. And even if you're not in those industries, the fact that there are people being put to work to build capacity in our economy is a good thing. The clean energy economy clearly needs to happen over the next 2 or 3 decades. That's going to be good for Long Island, et cetera. So I think even if you're not in those industries, the infrastructure bill, by creating more economic capacity in our area and in our country, is going to be a good thing. Now, remember, that's going to play out over a bunch of years. They're not going to start, rebuilding Long Island Expressway, tomorrow, but there's going to be over the next bunch of years. And I think that's going to be a long-term lift for the Long Island economy, over the next couple of years. So anyway, that's just some thoughts. And Tom, happy to answer any questions you might have, or anyone else.
Oh, that's great, Dave.
I do have a call in 7 minutes, though, so I got to.
Yeah, no, okay. Mark's got a question, and we'll make it less than 7 minutes.
I had a real quick one, David. Hi, I'm Mark. I'm a sole entrepreneur, but I've created a new piece of equipment for commercial contractors, which would be very big in the new infrastructure game. Are there any tips you could give me for getting revenue and financing to aid in infrastructure growth?
Yeah, so is it it's a physical device you're talking about?
Yeah,
Is
it's
that
a
what
brand new machine that's going to help contractors basically do jobs faster and cheaper.
and it's focused on buildings or roads or bridges or
Yes,
all the-
yes, and
all the
yes.
above. Okay. Gotcha. Yeah, I mean, the best thing to do obviously is to try to connect with some of the engineering firms here on Long Island, and I could probably help give Tom or Stefan some thoughts on that to share with you. Because you want to have you sold any of it yet, or is it just kind of a proof of concept right now?
Very early stage proof of concept, but municipalities would also benefit from it also.
Okay.
Dave, Mark is in the Seaweed incubator at Stony Brook.
Oh, okay. Oh, great. Very great. Sure. Dave Hamilton and the
Yep.
crew there. Good folks. So I guess the question is we can happily try to talk about sort of what connections might be helpful. One of the issues is obviously trying to get ahead of the game with regard to that. And one of the, those of you, I know those of you who make physical devices, it's kind of obviously challenging. You always have the issue of, do you license that out to someone else to kind of make, or do you try to make it yourself without knowing what you're talking about specifically? It's hard to know, but getting that first contract, obviously huge. Then you can also look at other, then you go to bank loans, you go to revenue loans, those kinds of things. Once you have a little bit of a proof, you have some buyers lined up, you obviously have a bunch of different financing options. But is this something that would be expensive to build the first couple of, or is this something that it pales in comparison to the actual cost of these projects?
That's the problem I'm at right now. I know what my production nth piece cost will look like, but to get small volumes out, it costs me a lot more because I'm not able to buy in bulk.
Yeah.
Right.
So let me.
There may be some grants. Sorry.
I was just going to say, it might be something we can take up separately, because we're
Sure.
going to run out of time. So let me try to make a connection separately and see if we can get a better answer for you, Mark.
But yeah, that's fine. Thank you.
Yeah,
I didn't
good.
want to hold
Thank
up the show.
Yeah. No, thanks, Mark. And thanks, David. So we have want to move along and introduce our last speaker for talk a little bit about her center at Stony Brook. Dan Ling Jiang has been introduced a couple of times by several of us for her role in being part of this team that created some of these programs. She's a professor at Stony Brook and has co-set up a center for entrepreneurial finance at Stony Brook College of Business, and I wanted to have her say a bit about that center, and also feel free to comment about other things that she's heard in the night tonight, and then at some point when she's in, we'll also have a brief wrap up of the session, because it is getting to be close to the end. Dan-Ling, please.
Thank you very much, Tom. Thank you for the opportunity to share things we do in the center. But before that, just want to reply to one of the inquiries about the grants. I have added a link about SBIR, which is a government grant for technology innovation that small business owners can apply. And there's tutorial online you can watch and to learn about those grants. So here in the Center of Entrepreneurial Finance, we work with faculty and student teams to help small businesses in the region to solve their real business problems. And we also do academic research and produce educational materials for free, so anybody can learn online. So can I share slides here? Just one slide. Okay, so basically, the center will, if you are a startup in particular, if you don't really have anybody to help you, you can come to our center and we'll try to team you up with student and faculty teams. And so basically to address some of the issues you have, in particular, how to get funding and things like that. We also organize free workshops, and many of the workshops are recorded and made it available online in the College of Business website about like entrepreneurial finance, like how to get basic funding, what's the process, and things like that. I myself also do like blockchain, crypto kind of workshops on campus. We also record them, make it available on our YouTube channel. And also, if you are a small business or entrepreneur, you are looking for like a formal, like a team to work with you with incentive, because the student have to get credit, you can contact Professor Gary Wolf, who is the instructor of the capstone course in our MBA program, the technology innovation course. There, they really assign a team, a student team working with you on your problem for the whole semester for credit. So the kids are very motivated there to help you to solve the problem, because that's how they actually pass the course. You can email Dr. Garrett Wolf and to talk to him how to sign up your project into his course manual. And also myself, I've worked with my students and my colleagues, and we started a website called stonyfinancelab.org, stonyfinlab.org. And there we have multiple pages with collection of all the resources online, including one page devoted to small business guide, especially a lot of local information, local support for local small businesses on Long Island. We also have a page for our startup guide. If you are an entrepreneur, you're looking for funding, there's many ways you can get funded, and you can also look at the page, get all the information. And also we have another page for blockchain and crypto, and that's another way to get funding and to grow your community. And also you can get a lot of information there. Of course, we have worked, the center has worked with SBDC on Stony Brook campus to create the webinars, materials, and to send our students to their tech enhancement programs to help small business set up your website and to adopt different technology. And that's something we also do with the New York State agency in this space. But anyway, so all of those resources, they are free, and they help us to fulfill one of our missions to help to contribute to the regional economy, to contribute to local business community, so that our students can learn, our community can grow, and we become stronger together. Thank you, Tom. That's my one slide presentation.
Well, that is the gravy on top of it. That's just a great presentation. Quick, to the point, and lots of really good resources. And let me just say, Danling herself, but her students, they are great curators of all the data that's out there. They really are. I mean, when they got all the data together when the pandemic was first happening, and we created these resource pages at Stony Brook College of Business, it was amazing. It was really thoroughly well put together, and I presume the same. I haven't seen the startup guide, but I presume the same would be true for that. So I highly recommend it. So we're at the 8:30 time. I thought we might have some time for sort of group discussion, but I want to certainly, and I'll stay on for a bit of time in case people do want to have a little bit of conversation. But I want to certainly say at this point, thank you very much to all of our speakers. You were great. You really were. You really had wonderful things to share, and also jump in all throughout the session to bring a lot of good value, very truthful, good value to this presentation. I thought it was terrific. So thank you very much to Max and Angie and Andrea and Dave and Dan Ling. Everyone. It was a wonderful session. We did record it. So it'll be, I'm not sure exactly where we'll make it available, but we'll make it available so you can see it.
We'll get to you. One quick thing, Denling and Max, can you share your slides with us? Not now, but then we'll send it to everybody.
I did, yeah, I have
Yeah.
sent the slides to
Yeah.
Tom. this
Yeah,
morning.
yeah, she sent it to me.
Now, all of the information are posted on the chat box as well, so you can simply copy.
Yeah, it's also in the chat box. It just popped in. All right, so anyone who needs to go, please feel free to go. I did want to just say a couple of words for the shift participants about next Monday session. We have a special program we've put together, which essentially is sort of an update on the work you've done in the previous workshop. It can be taken two ways. Either it's just a way for you to revisit the work you did earlier and kind of tune up a plan for 2022, or it can be a way you can put something together for this grant opportunity in mid-December. We are putting together a tool which we hope will help you take your plan and then think about how you would put a resource budget together for a loan application. It's not going to be something that's going to do your credit score for you. That's not our expertise. Our expertise would really be a matter of kind of answering the question that you raised, Teresa, of what would you do with it? That is to say, if your business is in a certain position, but if you think you could bring it to another level by doing certain things, then the question is, how would you use capital for that? And that would be what the tool would be, is to say, how could I take it from here to there by spending money on more marketing or adding video capacity? I don't know what it's going to be. It's going to be different for everybody. I don't know what it would be, in Mark's case, but you will know what it is if you spend some time thinking about it. You know what you might need to do. And our aim is to try to help you using our planning tools to sort of be able to label that so that you could talk to a banker about, this is what I need. And if it's a good enough story and your credit is good enough, then hopefully it will turn into something you could use. So that's the goal of next Monday, and we'll be getting together same time, same station, basically 7 p.m. we'll meet, and it'll be like the typical workshop sessions where we'll spend some time talking, and then you'll do some work on a tool and you'll be in small group discussion about it. That'll be how it'll be. And then you'll have some time between then and the deadline date. You'll have a little bit less than a month to work that out, working with Andrea or whomever, wherever it winds up going. I guess it's an online application, but we'll help you get it going if that's what you want. And I don't know if there are any questions anyone has about that, or anything else that someone would like to bring up. Well, we have a couple more minutes which we can spend. Teresa, yeah. You got to take the mute off again. You're muted,
I'm
yeah.
always the one asking questions, because it's so wonderful to have all this brain power here that can answer. And this is, you guys are going to think this is a really kind of silly question, but it has to do with understanding how banks operate. So we started a business account with a local bank, and I have a business partner. He and I, share the company 50-50. I'm the only one who can get access to the account. He can't. And that seems very odd to me, that only one person from a business can actually get access to the account. Does that make sense? Are we not asking the right questions, maybe? I mean, I'm sure, Angie, you have so many people who have, you have your CPA, you have business partners. I mean, how does that work?
I mean, I can only speak for Bank of America. So you're allowed, you're entitled to, you're allowed to. That's a normal course of business where there's multiple signers. You have signers that are, part of the structure, part of the organization, or you'll have signers like the owner's spouse that needs to be on there because the owner's in the field and the spouse is doing all the banking. There are titles for it. If you're not related to the structure of the business, or there's no ownership percentage for you, it's just a simple authorized signer. But that's a normal thing for most businesses. So most structures, they'll have multiple partners, multiple signers, multiple signatories, whether they're related or not to the business. So that's kind of odd. That did you try to get the other person on the account?
Yeah, we've met with them a couple of times. One of the problems is he'll go to sign on and the account will want, a security code that will come to my cell phone, like
Okay.
my phone. And
I
we
see.
have to be able to fix that.
Is your partner able to go into the bank and conduct transactions? Is the signer on that capacity?
He should be. He just can't
Okay.
get in there.
So it's so I do know that certain banks don't pay for that technology, and they're limited with their functionality in terms of having multiple users access their sites at different IP addresses or different computers or at the same time. So it could just be a disconnect between the technology of that bank and what you're looking to do for your business.
I think so.
Yeah, I think that's what's happening. If only the only area that's impacted is the online banking. If that partner is able to go into the bank and withdraw or deposit or get statements or whatever transactions you need, then they're a signer on the account. But it seems like it's limiting in terms of the technology that the bank is offering.
I think so too.
Yeah.
We're looking for a new bank.
It sounds fixable. Good luck with fixing it. Yeah.
Yeah, right. So I just wanted to say one thing. So Bank of America has a resource page for small business owners. It's bankofamerica.com/small business resource. It's a very informative a site that Bank of America put together. It's for businesses by other business owners. So it's perspective on people in the similar industries or in other industries. It's data driven, so it tells you what your peers are, what the averages are for, let's say, cost of goods in this industry and the averages for salaries, or it has a lot of information that's generated specifically for businesses. And a lot of my business clients love that site because they're always able to go on there and pull and pick things out of there that helps them. So, and it was very pivotal. It was very instrumental during the pandemic when business owners kind of felt stuck. Like, wait a minute, I don't have technology on my side. I don't know how to pivot. I don't know what to do. And it helped a lot of my business customers in our resource site. So a site that I want to check out. I don't know if you want to put that on some publication or some material, because we're down to 11 in the participant panel. I didn't get a chance to say that when there was 20 of us.
Yeah, no, Dan Ling has just dropped it into the
Okay,
chat.
great.
Dan Ling is
Great.
great. She's, like I said, she's a curator and a half.
I'm gonna add
So-
it to our page. Thank you very much, Angie.
There you go.
Okay, you're
Yeah,
welcome.
It is
You're
a good
welcome.
page because
Yeah.
that's Dawn used to talk about that as
Yes.
well, and
Yes.
it is a useful page. And it's
Very.
funny because people just don't know, even if they're banking there, they don't pay attention to this stuff a lot of the time. And I want to double down on the point you made about the personal bank relationship. This is something that I think I would preach and say everyone ought to do this before the end of the year. If you don't have the personal relationship on behalf of your business with whatever bank you bank with, go see the person and spend a half hour or 40 minutes, which is what is typically it takes to really establish. It does matter. It takes the time to talk about what your business is and about what you're planning, as you say. What are you looking to do in the next couple of years? It's not just give me a credit card, and it's talking about
Yeah.
what you're doing in your business. I think that's how you establish the relationship, which then helps you. It's when you get to know a person at that stage, when it's just regular. Then if you're in need, then they know who you are. And that makes all the difference when you're talking about doing anything relationally. And you drop in and say hello for the holidays, whatever. I mean, that's how you treat the person like a person, treat the banker like a person,
Right.
and they will do the same. Anyway, I think I don't want to extend it too long. It's almost 8:45. Thank you everyone for being part of it. It's great. We didn't hear from you, Josephine, but it's great to see your name there anyway. So thanks for joining us. And everyone else who joined us, both the speakers and the participants. I think it was a great session. So thank you all. We hope to see the Shift folks next week. And we promise to have a good session with you. So, and you can ask all the questions you want, Teresa. We need a questioner. Because if no one asks a question, where do you go then? Then what? All right. Good night, everyone. It was wonderful.
Good night.
Good night.